Well, what's most interesting about the first couple weeks of the year is that the bear market actually started in the middle of last year in small cap stocks and then spread as the year progressed. The biggest noteworthy thing in the first couple weeks of this year is that it finally infected the untouchable mega cap stocks that everyone hid in last year. So this is just, to me, another step of the bear market that right now we're very oversold. We're due for a bounce. We can bounce for days. We can bounce for weeks. But I think, unfortunately, this bear market will continue over the rest of the year, notwithstanding a short-term rally.
What's interesting about the China data overnight, it was weak. It has a weak headline, weakest in years and decades. Sure, but China actually rallied, and everyone else is rallying as well, built on the idea that, hey, maybe they'll add more stimulus to the economy.
Right.
Does that give you hope? Well,
the stimulus, the fiscal stimulus, the monetary stimulus, every time there's a hiccup, actually has us in the position we're in because it's built up extraordinary amounts of debt. So I don't want to see them do any more stimulus. I want them to just rip the Band-Aid off and get to a more sustainable level of growth.
Be careful what you wish for.
Rather than these continued steroid shots every time there's softness in the global economy or in a particular country like China.
Huge amounts of steroids injected into Western markets over the last 6 or 7 years.
Correct.
As we come off those, is that, in fact, the bigger reason for the sell-off in the last couple of weeks rather than the Chinese yuan?
Sarah's heard me say this for a while. There's no coincidence that every single time the Fed takes their foot off the pedal, we run into trouble. And the rate hike was the second phase of the tightening, the first one being the end of QE. And as QE ended, a lot of stocks started to top out. So this is just another phase. You inject stimulus, you get this little rush. Once it wears off, you fall back down again. I'd rather see the global economy adjust on its own rather than continuing to get these steroid shots because it's just an abnormal, distortive form of growth that is not natural, and eventually you have a hangover, which we're experiencing right now.
So we know your thoughts on QE. We know you're a hater of some of the central bank stimulus. As far as the fundamentals of the U.S. economy, though, it is a little confusing to hear J.P. Morgan out with earnings saying that its credit card business, it's as good as it ever has been. There seems to be a fundamental disconnect with certain parts of the economy and other very weaker spots.
Right. Certainly in the services area, the U.S. economy is doing much better. We know manufacturing is essentially in a recession. But the services part will be, the key will be the consumer. The consumer is obviously getting a great benefit from lower oil prices. But for those that rent, they're getting hurt. That's 35% of the households. Healthcare costs are higher, which is also a crimp on consumer spending. So I think as we're still in this mediocre state of the economy, which is okay because it's better than a recession, but it's not what we're used to. And I think it's just more of a muddled along situation, unfortunately.
Are there any bright spots, Peter?
Well, the bright spots is that we're finally reaching a point where central bankers are losing their effectiveness, which in the short term is going to be extraordinarily painful. But hopefully lessons will be learned from this, and the economy can adjust without the constant intervention from central bankers.